Okay. Okay. Mr. Enda, are you there? Okay. So as I was saying before, I said sometimes I want to sell the market, I want to buy the market, and the best place if I'm to buy the market is at a demand zone because that's the position where um, buyers push the market upward. And when it chases back to demand zone, which is a discount zone, the market ought to buy again. Then supply zone is a zone where sellers they actually sold the market, institutions they sold the market, and when it chases back to that very zone, it ought to naturally, all things being equal, it ought to sell again, which we call a premium zone. So one of the confluence that I want to look at is is the candlestick. What the candlestick is going to be telling me at that very zone there. What the candlestick is telling me. So if I am in a demand zone, the candlestick should, because demand zone is where buyers ought to now push the market back to the upside. So if the candlesticks get back to that very demand zone, then I should be expecting something like a bullish candle. That in other words, the bullish, the those that are bulls over there, the buyers that are over there should be able to overshadow the sellers there. Then for a supply zone, the sellers over there should be able to overshadow or dominate the buyers over there. So part of the things I'll be looking at is momentum. Momentum. Like for example, if you see over here, this very candle here represents momentum. Represent momentum. A great momentum. This and that momentum. This and that momentum comes here. Momentum. 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 Okay. If for any reason at all, if I was supposed to, let me say, for example, if I was supposed to buy the market here, I already determined in my mind that I was going to buy the market here. On seeing the way the market is pushing down to this side with this great momentum over here, one of the things that I should put at the back of my mind is that I shouldn't buy the market there because there are a lot of sellers that is pushing the market to the downside. There's a very high probability that this very zone over here is going to be violated. So what am I going to be looking at? I'm going to be looking at where the momentum for the sellers is going to be reducing. Then the momentum for the buyers too should equally increase. Increase in such a way that the momentum for the buyers should be greater than the momentum for the sellers. If I see that in a demand zone, then I should have some level of confidence to buy the market. Equally too for a supply zone too. If I see that for a supply zone, I should have the confidence to actually sell the market. So for example, you observe if you watch the way the market was moving to the upside, moving to the upside. This was great momentum, great momentum, great momentum. As it was moving to this very side, it started decreasing, started decreasing, started decreasing. Great momentum and reduced. Then sellers came to the market. At this very junction, if it's a supply zone, I can sell the market because I can see that sellers have come into the market. So when market is moving towards a supply zone, what I'm actually expecting, I'm expecting a decrease of the momentum of the buyers in the candlestick. The candlestick should be telling me that the buyers are losing momentum and the sellers are coming into the market. If I see that in a supply zone, I will sell. Then for a demand zone, by the time it's coming down, I'm expecting that the sellers will be losing momentum, then the buyer's momentum will be increasing in such a way that I will have confidence to actually buy the market. Do I need to admit them or the person has actually entered? Hello? Hello? Person has entered? Okay. So that's what I was saying. So I should be looking for momentum, 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 momentum. So like you see in this very case over here, moved up, great momentum. Then the momentum started reducing, 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 reducing. Then with the sellers got into the market. If this is a supply zone, I should sell the market. Okay, okay. Let me come, let me come, let me come. Okay, okay. Another thing I look for again is this. For a supply zone, I look for this, the candlestick, for the candlestick to print something like this. This is for supply. Then for demand, I look for something like this. Okay, so let's assume this is a supply zone. Price comes into this very zone over here. Of course, this one here is a demand zone. Price comes into this very zone here. What I'm looking for is this. When price gets into a supply zone, I'm expecting that price will react from this very zone. And after price finish reacting from this very zone, what I'm expecting, one of the patterns that I love very, very well is that I'm expecting price to take away this very high over here, this very high over here. When price takes this very high over here, takes it away, then come down again. Okay, and come down again. And what I'm expecting price will do is that price will now close. Price will close below the previous engulfing. I'm expecting price to close below the previous engulfing. That is one pattern. That is for supply and demand zone. The same pattern. That is for currency. For some time, I stopped synthetic for a for a long time. But the reason why I'm going back to synthetic again is because of I know that students will come up. I'll need to be teaching students, so now I'm going back to synthetic. And so there are some things I may not really because I've left some of these synthetic assets. There are some patterns that I may not know, some charts I may not know how they necessarily respond to price action. But I'm talking for currency. Though we'll go back to synthetic. They're all the same. So I'm expecting something like this. I'm expecting something like this. Like if I'm trading US dollar Canadian dollar is one of the patterns I use for trading US dollar, Canadian dollar. Once I see that in a supply zone, I sell. Once I see this for a demand zone, I buy. So, like for example, let's even leave that one. Like we say, look at this very candlestick now. If you see this very candlestick in a hello, okay. Mm. Okay, okay, okay. It's okay. It's okay. It's not that well, I'm just trying to be very, very, very honest with you people because um the truth be told, um if you between currency and synthetic, synthetic is more easier. It's easier compared to currency. So if you see someone that is let me just use this word. Let me not as if I'm exaggerating, but if you see someone that is doing well in currency, it should be able to do well in synthetic. Why? Because in currency, you are looking at fundamentals, you are looking at um, technicals, you are looking at a lot of things. But when it comes to synthetic, part of the things that you're only looking at is just very simple. The only thing you're looking at is technical. That's the only thing you're looking at technical. Very simple. So it is simple. I know with time, definitely I would catch up. So it's not an issue. But if you see it as and it's okay. No, not a problem. You can add currency pairs to the synthetic, but why I actually said that it should only be one is because I wanted those that are going through this very chain, I wanted them to be masters of it because I come to observe often at time when students or when persons, not only students, anybody at all, when we trade many currencies, when we try to look at many charts, often at times we don't do very well. And I gave myself as an example. I said I do very well when it comes to US dollar, Canadian dollar, and British pound, US dollar. I do very, very well. The other pairs, often at times, if I make money from these ones, I come and I lose money from this other one. So I come to understand that why not necessarily stick to what I'm good at, but because I teach students, I teach persons, so sometimes I still go out of my way to make sure that I still get to learn some of these very things. So trading many currency pairs most at times is not so good, but it's a reasonable suggestion you have just raised. I don't know. Maybe we can ask other students if it's something that they can do. Why not? So it's okay. Hello, are we together? Okay. Okay. So, like I was saying before, um, if I see this very pattern, US dollar, Canadian dollar, it happens often at times. If I see it, I take it. Now, like I said before, if you want to take a sell, if you are a supply zone, what you're expecting, the momentum of buyers will be reduced, then the momentum of sellers should increase. If I see this very pattern here in a supply zone, this very one, I see this bearish candle, then I now see this very one, I see this very one, it's an entry. If I see it in supply zone, then if I see the market going up, then I now see this very one here is a morning, is an evening star, evening star. This is an evening star. If I see evening star in a supply zone, it gives me a high confidence that I should take the trade. If I see a morning star in a demand zone, let me come down. Why is this thing hanging? It's not supposed to hang. Ooh, I think it's network. Please, who are those that are here? Can you please introduce yourself? I think Maureen is here. Who else is here again? Okay, Zan, welcome. Okay, this very one here is a morning star. If I see a morning star in a demand zone, I buy. If I see a evening star in a supply zone, I sell. The basic thing is we don't necessarily need to cram these candlestick patterns. Like I said, I gave a book I gave to you on the group. I expect you people to read it. I said the things you don't understand, please just leave it. But Charles Marvel to read it. And part of the things that is there is this candlestick pattern. You don't need to cram it because it's self-explanatory as time goes on. Most of other morning star, evening star, mm, um, bullish engulfing, bearish engulfing, mother candle, three white crew, three black crew, all those things you don't need to cram them. They will come naturally. The thing is that there's a story behind all these things. What you need to understand is the story behind all these things. Like for example, the evening star. What simply happened with the evening star is that buyers were actually in the market and it got to a particular time whereby buyers they lost their momentum and sellers came into the market and at the end of the day it sold. The same thing applies to Morningstar too. The same thing applies to engulfing bar too. So you don't need to cram all these very things. So the long and short is if I'm going to buy in a demand zone, I need a situation whereby the buyers would lose momentum, then I need the sellers to gain momentum. It will give me a high confidence that I should take the trade. Please, do you have any question? I want to continue. I want to move on. I think I can stop this one now.